Coworking, since the downturn, is the largest growing tenant as a class in the country by far. 71 million square feet of space. So you're seeing a seismic shift in how people are using their space. This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odum and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odum, along with Steven Silverman, back from another vacation, I believe.
What are you talking about vacation? I take off 6 hours and that's a vacation?
Well, I mean, that's you're able to go across town and have a little staycation someplace, right?
That's a vacation. Lunch is a vacation.
Lunch is a vacation. Hey, man, I had a great conversation today, as a matter of fact, with one of our listeners. We love speaking to our listeners, Stephen.
Yeah, I mean, we're all of the same wavelength. We learn from each other, and it's amazing the people out there, what they're doing and how they think.
Yeah. And I mean, for us, it's awful hard for us to get good guests on the show. And frankly, most of our guests come from referrals. I mean, a lot of our listeners that are listening to us down in Naples or Jacksonville, they are plugged into what's happening in their market, and they also have contacts that we don't. And so they're capable of making introductions for us to people that they find that could be a valuable guests. And it means a lot more than us trying to make that telephone call cold and not knowing us, not knowing what we do, and having to spend time to research whether that important person, the important guest, is going to take the time to spend with us and come on the show. So it definitely helps break the ice when we get these types of referrals. In fact, probably more than half of our guests are folks that come through referrals of our listeners.
And that's really critically important to what we do, because if we don't get the quality of guests that we're able to talk with, we don't all benefit from the education.
Yeah, exactly. Mike, I'm not Italian, Stephen. So let's, before you, make comments about how good my Italian accent is, but buon aiuto, Mike, buon aiuto.
Buon aiuto.
Buon aiuto.
Oh, okay.
Mike. He is with Insperity.com, and Insperity is a human resources firm. He's not a broker. He is getting into the investment game. He's been reaching out to folks in his local community and has some contacts for us. And he made a couple referrals to us, and that's much appreciated. I don't know if y'all know. Do you know what employee leasing or human resource management is, Stephen?
Sure. I mean, they're the middleman that connect employers with employees.
Yeah, exactly. And they're the guys who typically will actually have the employee-employer relationship, and they go to small businesses and help them give better benefits and manage those human resources, particularly for smaller companies. You're less than 50 employees that maybe can't afford to have a human resource person. But the point,
and they're pretty plugged into the economy. They know what's going on in terms of job seeking and job availability.
Well, the point of bringing up the human resources and stuff, I mean, it's for us, it's obviously, it's something we're starting to talk about as we're going to add some more employees. But I think it's more important that most of our listeners aren't brokers. They're not full-time investors. And so, here's a guy like Mike who's just out there in his community and looking out for us and listening to the show. And it's much appreciated that Mike, gives us those referrals. And, gosh, if you guys, out there, you've got folks in your market that you think would be good for the show, we're definitely all ears. It does take it's a big vetting process. But if you don't have those types of contacts, I mean, you can help us out by doing what, Stephen?
You can help us out by really...
How about giving us a review?
Yeah, a review would, well, referring, but also reviews. I mean, reviews is what our guests read when they decide if they're going to take the time to be on the show. So that helps us a lot, and it helps promote the show and get the education out there.
And where should they go to give us reviews?
Well, there's only one place, and that's www.investfloridashow.com for the website. But download the apps and give us reviews on Google, on Facebook, wherever
iTunes.
you can.
iTunes is the big driver of traffic for us, and also the Android store, the Google Play Store, also helps us get the word out that people are listening and actually care about what we're doing. Just a final thanks to Mike for reaching out to us. We appreciate the leads you've given us. We're going to follow up and see if we can't get some of those folks on the show. Stephen, one of the questions that we've had recurring from folks, not everybody's in single family and multifamily. That's the bulk of investors, right? That's where most
Well, just by sheer numbers, but we're real estate brokers. We're out there every day pounding the pavements, and we see what's going on in the industrial market, the office market, the retail market. We like to talk about all these things. And so today, what we want to really focus on a little bit is some of the discussions we've been having about the office market.
Well, obviously, in the last several weeks, its office market has been big in the news. We get questions from our listeners saying, well, I'm not really, for whatever reason, it's either single family's hard or it's not pushing the buttons that I want to have pushed in terms of what I want to accomplish out of life, what my investment goals are. And so they ask about retail and office and industrial, et cetera. Well, office has been one of those topics that people have been asking us to address because of WeWork. And I think maybe we can just sort of start from the beginning and give people a 30,000 foot overview of the market, Stephen, and then kind of work backwards towards WeWork and where they are in the market and what this means if you're thinking about investing in office and what that can mean to the office market.
Okay, so from my perspective, I had to give a talk at an economic summit at the University of South Florida about a week ago, and so I looked at some of the statistics. The office market in the Tampa Bay area, where we live and work, is at 7.5%. It's the lowest.
7.5%.
7.5% vacancy. Yes, right. It's the lowest vacancy rate we've ever really seen in this market, and Florida was particularly hard hit in the last recession, and this area in particular, because the recession came at just the time that a lot of new supply was coming on.
Yeah, and for you multifamily folks, you say 7%. You say, "Oh my gosh, I'd be slitting my wrists over a 7% vacancy." That's pretty gosh darn good in the office market. The office market is one of the more volatile, probably, I think it's the most volatile market, right? I mean, multifamily and single family and retail next, or in terms of volatility. Everybody thinks retail is really volatile. It's not. It's pretty stable, relatively speaking to office. And then office it was one of the more volatile asset classes. So when someone says that you're 7% vacancy on the office side, that's really good. You're in a good place in the market. But there's some stormy clouds.
Well, before we even get there, let's just talk a little bit about the office market, because one of the components of the office market is medical. And when you look at the numbers of medical office, you'll see that the vacancy rate is actually quite a bit higher. It's 9.5%. And that's a game changer, because people have always looked at medical as the most stable, most secure investment when you're looking at the office market. And there are a couple of reasons why that has changed. One of the reasons is that, first of all, the way doctors work is changing. They know it used to be that every doctor automatically had his own business, went into his own little building, and we used to call them doc in the boxes. And that's changing, isn't it, Eric?
Yeah, I mean, that used to be the model that a doc would either build his own space or buy space, make it the way he or she wanted it to be, and they would stay there for their entire careers, and they were great investments. The doctors would frequently buy them themselves, and that would be their retirement along with the sale of their practice. Or you would have investors who would buy those deals, and for 20 years you really didn't have to do anything, because these docs typically, when you lease space to them and fix them the way they want them to be fixed, they don't really want anything anymore. They don't want you in there intruding and making dust on any kind of tenant improvements. And and frequently, and I know you guys have seen some of your older docs. They're 50, 55, 60 years old. You go and see them, and they've got 1990s Miami Vice pink and lime green cabinets, right? I mean, they're not doing a lot of remodeling.
And that doesn't mean so what's happened now is instead of going into their own business, the new graduates of medical school are going to work for really large medical companies. And these companies take larger spaces. And that doesn't mean that, of course, there's still great revenue and good opportunities in leasing to these larger companies and leasing larger spaces. But now you're dealing with 800-pound gorillas. I mean, they throw their weight around.
Well, also, they don't want that. So you've got the migration from the space of the docs that are retiring that were in the dock in the boxes, the small offices, and they're challenged to try to get those filled again because the model has changed. So that's an issue. And then also the larger places like the Baycares of the world don't want those little 1,800 square foot doctor's offices anymore. They're, as you say, looking for larger space. So it becomes somewhat obsolete. That it's easy to rework it. You're converting it into something that's more functional.
Well, yeah, but just talk about Baycare for a second, because in our office market we have listings and we have spaces that that are leased by Baycare, and they're great tenants. But like I said before, they're 800-pound gorillas. They might decide not to renew leases. Instead, they'll keep extending leases for short periods. And I'm in one now where they're going through their 9th amendment to renew a lease. It makes it harder for an investor to sell that property because a new investor wants a long-term lease.
Sure.
And so there are issues. It's a changing environment. The other reason where office space is getting competition is a lot of doctors of these larger companies are now trying to position themselves in retail spaces. So you'll see urgent care or dentists going into retail centers rather than traditional office spaces.
Yeah, and this makes a lot of sense because you had some vacancies from internet disrupting the retail market on the big box and the retail side. And so the Best Buys in the world and the Kmarts of the world and the Borders bookstores shuttering their locations. And those are, in the last 10 years, we've had some issues with vacancy there, but they've been absorbed by some of these larger medical clinics that have moved in. And it makes sense because they're properly positioned as opposed to the old model of being close to hospitals. They have moved out into the suburbs with the retail areas and getting closer access to their patients, their clients. But let's not spend too much time on the medical side. Let's move into the more general office space, which is very driven by employment, which was what makes it volatile, right?
Correct. And so, we're at historically low unemployment, and that's been the driver for office space leasing now and the reason it's been so strong.
Yeah. And what we saw with office space in the 2008 downturn was that it was one of the hardest hit, if not the hardest hit sectors, because there's a lot of unemployment and, of course, laying people off and whatnot. Office was very slow to recover because of technology changes. There's technology disruptions that allowed people to now work from home, and Skype and telecommuting and whatnot now allows people to not have to maintain a large office space. And employees were pushing employers as they were coming back online and starting to hire again, that look, I don't really want to be in an office space. And also the employers were saying, well, I maybe don't want to hire you because I'm not ready to make a commitment yet. So we'll hire you as a 1099 and you can work from home. And hence, now this kind of leads us to why with the co-work space and the shared market space.
So what's been in the news lately and the most exciting component of the office market that everyone talks about is co-working space. And we've seen that grow from almost nothing into a huge part of the leasable square feet in the office market now.
Yeah, and it's just a way that's changed. And people say, well, why don't they just stay working at home? Well, guess what? That doesn't work. What they've learned is, we've experienced this ourselves, which we'll get into a little bit. But companies that sent their employees home or that were hiring from home, their turnover rate was much higher. And the reason for that is they don't feel connected to anybody. They're working from home. And of course, the employees, you'll say, well, Eric, why don't they feel connected? They asked to go home. Yeah, they did go home, but they don't feel connected. And so this is the reason in the exit interviews, they're telling the companies that I don't feel connected to your company. So I'm going to go try to find that. Of course, they don't blame it on what they asked for, which is to work from home. They'll never admit that themselves. But that is really part of the issue. They've lost that connectivity.
And not just connectivity, Eric. Like, what do you do when you stay home and work? You go to the fridge, right?
You're right. I mean, and it's I go to the fridge. I do my laundry. I find the soap opera, whatever. That's why I have to put on a uniform every day and go to some place so that it's game time. When I show up at work, that's the time that I work. And I try to separate that from my home. Well, employees, of course, were starting to feel that same thing, that isolation, and then realizing not feeling good about themselves because they're now working from home. They're not getting their jobs done. And so they wanted some place to try to feel connected again. And sometimes that's connected to their other fellow employees. And sometimes it's just to other people. And we saw a resurgence in coffee shops, right? Starbucks was that place that a lot of people were going to, but it's not private. You can't really have private telephone conversations. Everybody's looking over your shoulder at your whatever work that you're working on. Then you get friends that walk in and interrupt you. And it's tough. So co-working has become that transition space between coffee shops and full-time commitment on an office space.
Well, what co-working really did is it found a niche by addressing two really strong demands. One is the demand from landlords. It was able to come in, take big pieces of space and give landlords certainty. And then it was able to meet the need of the tenants who were more focused on flexibility. So they're the middleman, but by addressing two needs, they grew from nothing into a multi-billion, probably trillion-dollar industry.
Co-working since the downturn is the largest growing tenant as a class in the country. By far, 600% increase in co-working space since 2010, 71 million square feet of space. It is tremendous. So you're seeing a seismic shift in how people are using their space. And the companies like this too, because they got caught with their pants down in 2008 too, with these long leases. And then all of a sudden, a downturn in the economy. And now they've got tumbleweeds blowing through all this space. They really don't want the space either. So they're trying to figure out ways to mitigate that exposure on the leasing side. So co-working suits the employee. It suits the employer, and they're able to have their connectivity with their employees and make them feel better about it. Of course, here's the downside. There's always a downside to all this, right?
Well, there absolutely is downside because, look, let's take a company like WeWork. WeWork probably is the biggest in the space right now, and there's a couple of other large players also, but they are as you said, the largest office space by square foot in New York, in Chicago, and probably throughout the country. But what WeWork did is they went in and they solved the landlord's issue by taking really long leases. When we go out and we lease an office space, Eric, in this market, it's typically 5 years. WeWork spaces are typically 15 years. And then they took leases from tenants. Now, most of those leases are very short term. And I read some interesting statistics. WeWork has on its books now $47 billion in lease commitments, with their leases running for 15 years. But on the revenue side, they have commitments from tenants of only $4 billion for leases, and they typically are only a 15-month horizon.
And I know what y'all are saying right now. Okay, well, great. We don't own office space. Why do we care about all of this? It's not important to me. Yes, it is. Because what we've seen in all of these economic downturns is always a trigger in something that's not related to you, or it's indirectly related to you, that ends up causing a watershed event that comes down the pipe that causes stress on all asset classes and in the economy. So at the point of trying to have this conversation is not to scare you, but just trying to give you some background and data on potential issues that could come down the pipe. Now, we talked about it, co-working being the biggest consumer of space over the last 10 years. We talked about WeWork being the largest consumer of that particular segment. And It's daunting how much space they have. So one would conclude, if they're now the largest asset, the largest tenant in New York City, Chicago, Miami, Denver, blah, 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 what happens there's a collapse in that particular model? WeWork, of course, tried famously to raise some money publicly, and they pulled the offering because when investors saw this, they were shocked by the results. The model, which is committing to a long-term liability with short-term revenue stream, is a loser's model. I don't care who you are. We learned this, the real estate agents learned this better than anybody else in the 2008 downturn. You have a big office staff, you have a big office, you have all these fixed assets and a variable revenue stream. That is a loser's market. That's a loser's business, and you end up getting your head taken off. And if you didn't learn after 2008 to diversify your business, you're going to be in trouble. And so you look at WeWork, who are committing 15-year term leases, and then all of their members are month to month, maybe with at most a 6-month commitment, that you can see that there's really these long-term liabilities, long-term cash outflow commitments with variable revenue stream coming. That's a recipe for disaster. So, okay, we've got this data out here, Steven. What do you think? So in the largest growing asset and class, and they're the largest tenant, not just WeWork, but co-working. What happens?
Well, just to piggyback on what you said. So WeWork goes in, they take these huge spaces. It's an expensive build out, and typically the landlords are doing the build out for them. WeWork is not doing the build out. So it puts all these landlords at tremendous risk.
Sure.
And not only that, even running with their current model, for every dollar of revenue that WeWork takes in, they're spending $1.10. So they're losing a ton of money. WeWork alone this year probably lost $2 billion. It's if WeWork,
their cash burn rate is phenomenal.
They're burning through cash. So if WeWork was to get into trouble, all these landlords and all these office buildings would get into trouble, because how are they going to suddenly re-tenant that space?
And it's blue skies right now on the economy. The job market is reflecting that. And so, but what happens if all of a sudden you have just a small blip? WeWork is really going to get hit hard. And if you look at this, it's not without precedent. WeWork positioned itself from a marketing standpoint as a tech firm. You're not a tech firm. You're a real estate firm. What are you talking about? But all of SoftBank and their funders and everything sort of looked at it and said, well, they're tech connected because they have this. No, you're not. You're real estate. Even though you're incubating small firms and you're breeding those type of small startups, does not mean that you're a tech firm. You're still brick and mortar. You still have a long-term commitment on a brick and mortar space with people your customers that are going to be very volatile, their ability to be able to stickiness to be able to pay you over time. So, they're the fastest growing, but they're the largest asset class, the largest tenant in many markets around the United States. But at the end of the day, Steven, what percentage, because it's a little bit of like, now that we've shocked you, we scared you, we got your attention, how much of that market is the overall office market nationwide? Co-working in general.
I mean, I haven't read up on this, but I'm going to take a guess and say it's probably like 5% or 2%. 2%. Okay. 2%. But let me point out something else. Like, this enthusiasm for WeWork, from WeWork, was infectious, because it's not just the big companies. There are numerous small landlords throughout the entire country that looked at this as an opportunity. They said, wow,
to solve their vacancy problems.
I can solve my vacancy problem. Not only that, I'm going to get, for the small 600 square foot space, I'm going to get $800 a month. I'm getting such a good rate per square foot that it's just going to be a wonderful world tomorrow. What they didn't count on is how difficult it is to run the spaces, the amount of staff you have to commit, and the services you have to provide. And then the tenants just go up and leave. So
in the middle of the night.
So they're not factoring in the much higher vacancy. There's no stability.
Sure. I mean, they're looking at that cash cow and saying, oh, well, we're renting at $30 a square foot for our tenants, normal tenants on a long-term lease at, whatever X law firm that's in that space. And my gosh, we can get $90 a square foot at a shared office space. So this was the candy that was out in front of them, the carrot in front of the horse. But just getting back to my point, 2% is not a lot. And we've seen these sorts of dire predictions. If WeWork collapses, all of a sudden, let's just say that WeWork's got 1%, half of that, which is pretty aggressive. I'm not sure what they are overall across the country in terms of so let's say it's 1%. We heard these types of Armageddon scenarios play out in the retail side. Oh, when Kmart goes under, when JCPenney's goes under, everything is going to end. It's going to be just an implosion. I don't think that's going to be the case, Stephen. I mean, we've built up all of this like to scare you, but we're also trying to give you a complete picture of what's going on here. What do you think? Let's talk about that. 2% of the total office market's controlled now by co-working space. And let's say half of that, for argument's sake, is WeWork. And WeWork files bankruptcy and defaults on all their leases. What do you think is going to happen?
Well, first of all, I think we shouldn't just classify office space as office space because there's different classes of office space. Pretty much companies like WeWork go into Class A office space, into these big, beautiful buildings that provide this great atmosphere for their tenants. So I think that the burden of any failure is going to fall much more on the Class A office space than it will elsewhere.
Well, when we talk about co-working space, man, you've got it, and I'd like to see the breakout by somebody. I don't believe I've seen any data that have shown what it is across asset classes. But co-working is not unique to Class A. It is, WeWork has some Class B in retail centers too. They build it out in nice Class A, but they're trying to be close to whoever their members are going to be. And so this is, Class A or Class B, whatever. It's definitely towards the upper end of the range. But we know here in Tampa and St. Pete and other markets, Naples, we've been down to, we've seen some of this co-working spaces, and man, I'd be hard pressed to call it Class D space. Is pretty bad. So I think you're seeing co-working across. But
the big ones, the big guys like WeWork and all those guys really have nice space.
Yeah, they have nice space. Industrious, WeWork, Regis has some. Trying to remember.
But Regis is much more, but Regis, I believe, is much more diversified. Their spaces aren't as big and they're in a lot more different cities. So they have a lot more flexibility.
Well, and Regis is an interesting model because the parent of the predecessor of co-working was executive office space, and people wanted to go in and close a door, blah, blah, blah. What we've learned is that executive model is not so great anymore. Because people learn from the executive spaces that they're going from home to work in an office. They're really looking for some degree of connectivity. So going into that old school office space, close the door, that model's changed. And the people are going, think about one step up from a Starbucks, a little bit more privacy than a Starbucks, but not your closed door office spaces. That's essentially what co-working is. So if you look at like Regis had a similar situation back in the 90s, where they almost filed bankruptcy. They got into serious problem because of the same situation that you've got long-term liabilities with variable revenue stream. And so when the economy had a little bit of a blip, Regis almost went down the tubes too. But Regis saved itself. And I think we can go back and look at the Regis model to see what was going to happen with WeWork or some of these other co-working spaces that might be a little bit too levered and might experience some downturn. Regis did save itself, and then they're pretty strong now. They've reworked their model. But I think what you see is what I personally think is going to happen. Of course, if you start talking about punditry here.
Yeah, everyone's got a different.
Of course. They're like, everybody's got one. But I can tell you that I would prefer to look at what historically has occurred and try to make some sort of application to what's happening now. And what you're going to see is just because they're going to cough up 1% of the New York market doesn't mean all of a sudden 1% of that space is going to come back into into the market, and then all of a sudden it's going to drag down the entire New York market. No, what you're going to see is that these landlords will step up, and if WeWork or some other of their office co-working spaces default, they'll step up. They see what's there. They're going to try to salvage what members are there and scrape all of that for themselves. And you'll see some absorption. The co-working model, Stephen's not going away. It's going to continue to grow.
It's here. It provides real benefits. There's some disadvantages too. People, they have some distractions. They don't get privacy, but especially with the biggest generation coming up of millennials, it gives them the flexibility that they need and the connectivity that you spoke about.
Yeah. And it's not going to go away. It's going to continue to grow. It's going to continue to be an evolving type of tenant. And so, you're not going to see it just all of a sudden like, oh my gosh, the bottom fell out and Armageddon in the office space is coming. I don't see that at all. Is it going to cause some stress? Yes. Yeah, you're going to see some spaces be given back because, as always happens with real estate, investors get over their skis a little bit too far. And then what you end up seeing is a little bit of a correction. You see a correction, sometimes a big correction, and that people will come back in and fill that space and figure out how to rework it. Sometimes that can be in a painful adjustment period, but I don't foresee WeWork being this Armageddon for our economy. It's just too small a piece of each one of these markets overall from a 30,000 foot view, a big pie view.
Well, that being said, it still could be a really severe dislocation if something does happen. But so let's talk about something else in the office market, Eric. Where do you think there might be opportunities? I have my thoughts on where they are, but do you have any thoughts on that?
Well, let me tell you why don't you tell me what yours are so I can criticize yours?
You sound like my wife.
I learned from the best.
So my thoughts are that, as I mentioned before, the supply of office space is far less than the demand. And for the first time now, we have new building coming up out of the ground. A lot of new space is coming onto the market. The difference is that the cost of building is now much higher. So for instance, let's take our market, Tampa, for instance. Downtown Tampa, you can probably rent decent office space for $35 a square foot. When all this new space comes up in the Channel District and elsewhere, and Midtown, it's probably going to be $45 or $50 a square foot. Yeah. So the cost of new space is going to be much more. And yet there's been almost no speculative development of office space. So all the Class B and even the Class C, but I prefer Class B that was built where people have their own businesses and their own offices. That's not being replaced. That's not being increased. And I think there are opportunities there, finding the right building or the right investment with some good tenants, because they're not making more of that space and they can't make it at the same price.
And if you look at what's going on in the market, you also see more human resources per square foot than we've ever seen before. And this comes back to the co-working space. And remember, we talked about that the office market space is tied directly to employment. So you're cramming more people into a smaller space. Not really. What's happening is that people are rotating their job sharing, their desk sharing. So you're seeing more human resources. It's probably less apt to have severe ripple effects on the office market, probably be less volatile going forward because more and more people are sharing that same square foot. And I'm not saying it's not going to all of a sudden become as stable as the apartment market or the single family market. What I'm saying is that it's become less volatile because there's more human resources inside of each one of those square feet. So, the market is changing. We believe in the office market in certain areas, in certain locations, in certain environments. Some of them are going to be losers in this game. I wish I had a crystal ball, Stephen, about this stuff, because I would be maybe not sitting here talking to you if I had a crystal ball.
Yeah, I'll lend you mine.
Why are you here talking to me?
I once had a professor at business school, and he said, people keep asking me what I want for Christmas. All I want for Christmas is a copy of next year's Wall Street Journal. That's all I want.
And you never get it.
Yeah. So anyway.
Guys, wanted to remind you, Steve, is there anything else you want to talk about the office market?
No, I think it was just our perspective on it. You know, we're brokers. We're out pounding the pavements, as I said before, and that's just our perspective. We'll be glad to hear from anybody else if they have any other thoughts on it.
Yeah, certainly where everybody has got some thoughts that maybe they're different from ours. Like to hear them. If so, if you want to send us an email or you want to go on the investfloridashow.com site and leave us a voicemail there, we'll be happy to share that with the listeners if you've got some different viewpoint than what we have, and we'll talk about that. In the meantime, as a summary, I think you and I would agree that the co-working space has grown significantly. It's going to continue to be the fastest growing sector of the office market. WeWork is a disruptor in this space, and certainly their tenuous financial situation could cause ripples. But I don't think we're at a stage right now where we look at this particular evolution of the office market and say that what's happening could be catastrophic if we get a hiccup from one of these guys. Would you agree with that?
Well,
hurt, but not catastrophic.
The whole economy in America is changing. You know, we've become more and more of a service economy. There'll always be office space. And so you're right. It'll be a ripple. It might even be a little bit of a wave, but in the end, it'll be absorbed.
Right. So guys, wanted to remind you, if you have any opportunity to go on, give us a review. Also, go to the Invest Florida Show and get on our Facebook page. We've just added a buy sell section as well as a discussion section. Love to interact with you guys on there on Facebook if you have a Facebook account. And any you folks that are going to be around for the new year or around the holiday season this year, we'd love to have you stop in. December 4th, we're going to be having a reception at our office celebrating Steven's dog. It's her.
She's not my dog. She's my associate, and she's a very important member of my sales team. All
right. Well, we're going to have bartenders and dancing bears and the dog, so you're welcome to come by and experience that with us on December 4th. And we look forward to chatting with you. But go on the Facebook page. Steven, anything else before we let our listeners go?
No, again, please remember those reviews. You can just send one, say, hey, I disagree with everything Eric said, but what Steven said was pretty good. So
I get those from your mother every week. All right, guys.
Thanks, guys.
Until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odum and Steven Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida Show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida Show.